Good afternoon, everyone. Welcome to the FX Hour for the Shadow Trader. I am Blake Young, taking you through the next hour as we discuss all things Forex. And really, we're going to be doing some intermarket analysis. So last week we hinted at it, went into it a little bit. Today we're going to be talking about price patterns in those intermarket analysis tools so that we can identify where those next moves could go. And we've seen a lot of these, and We've actually seen a lot of the expected moves happen over the last 2-3 weeks. We've talked about where oil is going to go and where we expected the euro to go and what we expected to happen with the pound and what we expected to happen with the banking system. We talked a lot about different things, and so far we're seeing a lot of it do exactly what we thought. But we're also getting a lot tighter volatility, and we're going to get to that here in a minute. I want to remind you that you can follow us at MyTrade. Go to MyTrade. Search for FX Trader under Shadow Trader, FX Trader, and you can follow us along with the Swing Trader, Paris Trader, and the Weekend Update and all the other Shadow Trader articles and newsletters. So follow us there, join us there, and we'll look forward to seeing it on that as well. Be aware that that also gives you access to the newsletters, updates, charts, etc. that we look at. Let me go over to the charts and change our image so we get a cleaner chart image here. And just going to duplicate that. That way you can see. Nope, wrong one. There we go. And last week, should be able to see the Euro-US dollar chart right now. Last week we talked about the market forecast and some of the things that are going on. We do have some situations where we're watching for clusters, and we'll keep the market forecast up here for a minute because we are going to hit the intermarket analysis. Yes, S&P, we saw try to bounce off of this point right here. Not a lot of support levels there. Market forecast is still bearish. We talked about there's a very weak support line, and we expected. But we actually talked about up here that we expected a 5% correction. And let me draw a trend line off of that so we can get an idea of where that 5% is still potentially going to move. So we drop this down about 5%, and it gets us back into these previous highs. Maybe not into the previous support, but these previous highs where we had multiple tests of resistance and consolidation in that area. So I'm looking for the S&P to still drift down and retest 1880. If it can move a little bit lower, obviously this support level and then the next support level for the bigger push all the way down about 10% down to 1811, which we haven't had a 10% correction in the last year, really. And so that is potential targets on this if we see fear continue to kick in and push pressure down on this market. So as we're looking at this, S&P down, fear up. So as we're looking at the fear being higher, this is where we're going to get into my first intermarket analysis tool that will take us into the end. So we'll get right into Dow's favorite currency pair. But we're seeing the VIX rise, and we're seeing the VIX push into these areas that it hasn't been for April, May, June, July. Low volatility, April, May, June, July. Last year we had, or this year, early in the year, I should say, from late January, early February, and to April, we had a lot of consolidation. We had but it was high consolidation with a little bit higher volatility. This time, we're moving into that volatility. This time, we're pushing up into the highs, so we know we have a lot of uncertainty and volatility kicking in. When volatility is kicking in, we have uncertainty rising. What we have seen, or we know from the past, is that fear drives money into safety. Fear drives money away from higher risk trades. And so the higher risk trades and more uncertainty, the less confidence we have in the markets, then the higher likelihood that we're going to see profit taking in the high risk areas. And the yen is one of those situations. The yen gets sold and sold and sold and sold as part of this carry trade, and it's a weak carry trade. I would say it's a very weak carry trade because we really don't have a lot of interest rate differential between one currency or the other. But the fact is Japan has been in the 0% interest rate for almost 20 years. So we're looking at this, we see this major sell-off of yen over years, and that sell-off causes a lot of shorting of the yen. And what they're doing is they're shorting at a 0% rate, basically borrowing by selling yen and borrowing a 0% interest rate. They're doing that, and that causes lots of short positions. When volatility kicks in and we have uncertainty, that is a highly leveraged, high-risk trade for banks to have that many short yen out there. And so what happens is as the volatility increases, like we saw here on the VIX, the yen generally will strengthen. So let's start with the 6J. and we look for the yen to strengthen. Now, this is a short-term strengthening here, but remember that the dollar is also a safe haven. So when we're comparing the yen to the dollar, it doesn't look like much. It looks like a small little rally. It is a little bit of leaving the dollar and going to the yen, but the real kickers are the ones that are based on commodities. So we look at crude light, and we're going to put the couple pieces together. And then I can hit some discussions of, yeah, we can hit the high yield bonds and the junk bonds. Absolutely. We can look at dries, sure. But as we're looking at this crude light, we talked about this. We talked about the target of 97, well, 98 and 97, and we've hit that. And now today we're trying to break through after retesting near-term resistance. So we tried to bounce yesterday. We rolled back over. We got bearish. There's some weak support areas near 96, 95, and way down here. Now, one of the things we watched, and we're going to pull all this together again, pull all the pieces together. But we had a lovely little trend, channel, whatever you want to call it, going on through here. And we're right at that support level here. Now, if we break this, and it was a sell-off through very short term, but if we break this, this channel can happen one more time, I think, and that channel could push us all the way back down to these lows, which pushes us back down to 91. Now, 91 could hit very quickly. If we can clear those lows and continue lower, we're talking about in the next week or two, we could see oil prices continue to slide and fall, and if it falls back down to 91, then we're going to hit this long-term price channel. The Canadian dollar gains a lot of strength when oil prices are going higher because they sell a lot of oil. And so we're looking at that sell of a lot of oil and that idea that they're looking to gain every time oil prices go higher. What we would expect is if oil prices are falling, that means it takes less and less Canadian dollars to buy oil from Canada. So when the U.S. is buying oil and oil prices have fallen from 107 down to 97, and we've seen a 10% drop, then theoretically it's going to take 10% less demand to buy, or less demand of Canadian dollars to do that. So let's combine the two. Oil prices are falling, which means a weakness for the Canadian dollar. The yen should be getting stronger, but not necessarily compared to the US dollar because they're both safe havens. So we look at the idea of the Canadian dollar, and you can see the Canadian dollar is absolutely weakening, absolutely breaking through support, and continuing to drift lower. So the move that we saw in the Canadian dollar from here to here, and that channel we could even look at this way, we've cleared that support, the horizontal support, and the next channel already. So that being done, we've looked for the next target. And we're going to take that, we're going to duplicate drawing, and what do we know? We have a target that should get us all the way back down into these areas. It could take a little while, but I'd expect 90.21, if not all the way back down to these levels, even the horizontal support down to 88.62. Now, that being a potential target, first 89.95, 89.90, somewhere in there, then we'd expect the Canadian dollar to be weakening compared to the US dollar. We expect the yen to be weakening even compared to the US dollar, but then a solid trade should be the Canadian yen pair. So we look at those two things about higher volatility, falling oil prices, and what do we have? We have the Canadian yen breaking through support again, and this is probably a stronger break of support and resistance than on the other ones. You can see all this consolidation through here. Let me get rid of this Fibonacci. This previous resistance, this consolidation, even a little bit lower in this area, in that consolidation, you can see we had resistance, 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 and support, and then we broke through. Now there's a little bit of consolidation and noise here, but I would expect the Canadian yen to continue drifting lower down to 92.89. I kept looking for the Canadian yen and the euro yen and the pound yen and the New Zealand yen to give me signs that it was going to bounce at the support level because I was going to look for an opportunity to go long. But as we see here, it has broken through that support level. And having broken through that support level, now I'm watching to see can it hit the next support level. So let's combine the new current lower highs, lower lows channel, identify where support levels could be, and unless it sells off really quickly tomorrow, we probably won't hit 92.70, and we'll probably hit a little bit lower, even 92.50 over the next 3 days. So the Canadian dollar could give us another 100 pip move down to the downside. Now, while I'm saying this, I do want to come back and hit some discussion on the idea of what's happening with some of the other markets and some of the things that we might look at, because we saw the Canadian dollar weaken. and we saw that sell-off. There was no major announcement for Canada today. It was all oil-driven, all fear-driven, putting money into the dollar and putting money into the yen. As we look at the S&P falling down and reversing yesterday's small bounce, and we look over to the bond prices, and we'll get to your junk and your HYG, your JNK and your HYG discussion of high yield. But you can see bonds holding up. That means there's still demand there. We held up at the same price. We tried to sell off, but we held up at the same price, holding in this consolidation area. And so bonds have not been being sold off. There's still demand for bonds is what that tells us. And so the demands are holding up there. Look at the ZN. This is the 10-year. You look at the 10-year. A little bit less demand for the 10-year versus the 30, but we're holding up again in spite of the big sell-off. We've been able to hold right through here. And so bonds have not fallen. That means we have the 10-year Treasury yield, the TNX, and it's going to be holding, but it's holding at these low rates because the demand is generally high for the bonds. It's held at a high level. So higher demand for bonds means lower yields, and we're keeping the yields fairly low. Now, with low yields, as C is talking about, there's also usually demand for instruments that they can count on or rely on for higher yields when the yields are low. Well, this is the Barclays High Yield Bond Fund, and a lot of people get afraid of this, just like we were talking about with the yen. They like to get in these positions when there's confidence. Let's put our 50% line in there. They like to get into long-term bullish positions on things like junk and HYG. They like to get into bearish positions on the yen when they're feeling fairly confident. They're willing to take these leveraged interest positions. But when fear kicks in and starts to change that, this can actually be an early warning sign. When you see that the demand for these high yield are breaking out, you can see we broke out on July 10th. Let's go back and let's look at HYG as well. Looking at some of the support levels. Support and resistance through here. There's demand when we're feeling confident and feeling comfortable with this. This brings out July 7th and really have a nice bearish break of support on the 9th and the 10th as well. So on the 9th and the 10th, we have this warning sign that says we're getting away from high return because they're higher risk. There's more uncertainty. Now, I'm not afraid of these bonds, these high yield bonds. They're not, when they say junk and they say high yield growth, people think that they're terrible, but it could mean that they're just B, A minus, B plus, B minus paper. That's not necessarily failure. It's not bad bonds that are going to fail. It's corporate bonds that are not as highly rated, so they're not investment grade. Now, if we look back here, look what happened on the 7th and the 10th. There's the 7th, create a 3-candle reversal there. There's the 10th. So we had warning signs when high yield growth, or HYG, I keep saying high yield growth, high yield bonds and JNK junk bonds, ETFs, were already breaking through their support levels and their channels. We saw that back here in the S&P. That was really the last push. We stopped climbing at that point, and we put in a high, topped out, and then we've rolled back over and broke through support. So as we look at this, again, we can see that there's still some bearish pressure on here. Let's duplicate. We're going to do the same thing that we did on oil. We're going to duplicate it twice. There's once, twice. We're right at that support level. A little bit of a bounce off of there, but overall we're still in a downtrend. I would not look at this as a reversal yet. Talking about our candlesticks and the discussion we talked about last week, even this candlestick yesterday is not quite enough to switch this trend to this reversal. So as we're watching for this to continue lower, I'd be watching this resistance area in here, 40.88. If we reject resistance and roll back down, then I'd be looking for 40.02 as a potential support level. If it falls down to 40.02, 40 even, and then gives us a bounce and then breaks through this resistance line, that's when I might be looking for confidence to be coming back in the market. This could be really seen as a risk play. These junk bonds and the HYG are telling us when we're willing to put risk back on the table. Put it that way. And so these can be early leaders. They can be leading indicators. And that's when we're going to see money move back into those instruments. So let's hit Groupon really quickly for you. Groupon obviously has created a higher high, higher low as of yesterday. Breaking out through this price pattern, and maybe we go back to here and say we had higher highs, higher lows, but we're continuing. How about that? We're continuing the bullish trend here. Today was a bullish day. Earnings just barely happened. Let's look at the intraday. Oh, not good. Oh, Wilbur. All right, let's go back here and let's look at where we would expect support. That means the trend support takes us all the way down to 629. Let's duplicate that since we know we're breaking through it and we've missed earnings. Same price can come to play, and I would expect us to drop all the way back down to 529 at this point. Look at the intraday again. 598. So solid breakout, continuation after that announcement. Earnings obviously missing expectations. And as we're watching that earnings miss expectations, or at least not making the market happy, then I would be looking back to previous trend and horizontal support levels back, call it 528. All right, so let's go back in once again, and let's look at, they up their guidance. What they say, I've upped my guidance, so up yours, right? Oh wait, no, that would be a different thing. No, that's not nice. No, they've if they up their guidance, I would think that would, is it because they upped their guidance before and then missed? I'm not sure. So let's go back. We talked about oil and the fact that oil has been falling down. Gold has been fairly stagnant. We've really seen it trading in this range right through here and right through here. Now, I've looked at 1280 and 1300 probably as my key levels. I think you could probably bring it in a little tighter. You could also move it out a little bit more depending on how big of a breakout you want. But you can see we just keep consolidating tighter and tighter. And so in between 1280 and 1290 and 1280 and 1310, this indecision, this consolidation, this stop here, just because it's not going up doesn't mean that Aussie can't go up. Just because it's not going down doesn't mean the Aussie's not going to go down. When it's trading flat, it just tells us this is going to have little impact to the Australian dollar. Everything else that's going to impact the Australian dollar is going to come into play. This morning, well, when I say this morning, I'm saying like midnight, we saw the Reserve Bank of Australia come out and they said we're leaving rates alone, and then they provide their guidance, and the guidance can really give you that move. But gold itself isn't going to provide that jump. So we jump over to the Australian US dollar and we can see that yes, the Australian US dollar is down since last night, but not enough to break us out. So not overly positive, not overly negative. We kind of sat there quietly on the Australian dollar. But what we can do is we can go back to that gold price and we can say, let's combine the two. Let's look at the fact that we have sideways consolidation, but we have long-term consolidation as well. And I'm going all the way back here and looking at some of the long-term support and resistance levels. So as we're looking at this consolidation, this triangle going all the way back to here, as we're looking at this consolidation, if it breaks through the upward channel, I'd expect it to also break through the upward resistance line. So if we break through 1320, let's watch for 1371. If it breaks down through 1281, let's watch for 1200. And we're going to watch for that, or maybe even 1180. But we're going to watch for that in the near term. We'll look for the shorter term breakout, just like we talked about candles, and then we'll look for that to domino or spin out into the breakout of the top resistance or the bottom support levels. We can use the same thing going back to December and January, February, March. So let's go back to January. Well, December. Let's go back to December. And let's look at the same support and resistance levels we might be able to identify there. The trends that we had in the Australian dollar broke here, and so now I don't know if we can really anchor off of this level. There's not a lot of indication that that's an area we should anchor. But we have a resistance, horizontal resistance, right through here, and a short-term downtrend right through here with lower highs coming down to this level. Now you notice that's almost equal. I like it when it's symmetrical. When I don't have a very strong support level, when it's symmetrical, it tells me, oh, that's probably all right. That's probably about the level we need to look for. There's another little support level through here. So we have a different type of channel, a wider channel on the Australian US dollar than what we're seeing in gold. But it really is only 200 pips anyway. A breakout above or a breakdown below could tie us all the way into these levels. And then we're talking about a move potentially on the Australian dollar is nearly 950 pips. But I would start with this 200 pip move. I don't have to wait for the long run, but I could look for this shorter consolidation through here. At the same time, I'm watching for the shorter consolidation on gold. If it breaks out on gold, to the top side, then I'd expect it to come up through this. If it comes up through this horizontal resistance, it should break the top resistance, and then I'd be looking back to the highs of 97.50 and then potentially the full 1,000 pip move. But right now, gold is flat to down slightly. And so with flat to down slightly, I'm expecting this to break through this shorter term consolidation and retest 92.29. If it breaks 92.29, I'm looking for a move all the way back down to 86.59, because then we have a potential long-term change. Now that's a big move. 950 pips is huge. I mentioned this earlier. We've seen some breakouts, some uncertainty, some moves in the market. And what we've seen, oops, let me type it in, average true range. What we've seen in the Forex market, look at this, Australian US dollar. A year ago, our average daily move, our average range, our average true range was nearly 120 pips. Currently, it's 52 pips. So we're well below half of average volatility, and it's not just for this year. If we go back on the weeklies, you can see our average weekly move was 435 pips, and currently our average weekly move is 115. That tells us that our average week now is moving less than what we were seeing on a daily move earlier this year. And so the volatility has really dried out. And let's go over the Euro US dollar. You can see the same thing here. Average directional move on the Euro US dollar, 415 pips, currently 123. And we could go through about every currency pair out there, and you'll see our volatility and our directional moves and our big moves in the currency market have dried up. And it's because every central bank weakened their currency over and over and over again. And so as they keep weakening their currency, then the ranges, you're not going to get any really solid punches out of 2 90-pound weaklings. Yes, someone's going to win, someone's going to lose, but with 2 90-pound weaklings, it's going to be a slap fight, and it's just embarrassing to watch. So we're watching for these breakouts, and we're not really expecting significant breakouts in the short term. So as we're seeing the fear kicking back in, we see the volatility kicking back in, and if we see a bigger sell-off in the markets, and certainly if we see gold falling through its support level, this could be the breakout. And if we build up that pressure, we see the breakout of the market, and see the breakouts more significantly, specifically in commodity prices and volatility, then we are going to see the bigger move in these currencies. And what you'll see is a bigger move in the currencies, and we will see a delineation of all these weakening currencies. And someone's going to come out on top, and someone's going to suffer. Right now, the only reason why the dollar isn't weaker is because others are weaker than they are. It's not that the dollar is showing strength, it's showing that it's showing less weakness. So as we look at the dollar index, rolling back here one more time, the dollar keeps showing the strength, but again, it's comparative. This is comparing the dollar against all the major currencies. So about 55% of the dollar index is the dollar versus the euro. So the euro is selling off today, and it's no wonder the dollar index is rising. Now Dallas is going to get even more specific, more tightening, really zooming in. Yeah, and Money Miser, this is what they'll use to justify it. You have Pimsler, whatever. I never remember his name. But they're saying, hey, we should be done already with our buying program. Right? They say we should be done with our buying program, and we're looking at this, and they're going to say, hey, look, dollar Plosser, thanks, I couldn't remember his name. Drew a blank. Long night last night. So as we're looking at this, and we're looking at Plosser, who is my new friend today. Actually, he's my friend before, but he gets extra brownie points today for remembering his name. So as Plosser's calling for it, and we're seeing other discussion points, when they're looking to say, let's finish this program, let's end this program, they're going to say, look, the economy is still strong. We're seeing good job data finally. We're getting all these things in the economy to show us that we're doing well, and the dollar is strong, so we can get away with the idea of hiking rates, because we're not concerned about this. We can hike rates, and everything is going to be strong, and away we go. The problem is they'll use this to justify that, and hiking rates will actually increase the demand for the dollar, which actually stop inflation, what little inflation they have. The stronger the dollar gets comparatively, then we will have a stop in the march that they keep saying we want to see 2% inflation. If you raise rates on top of an already strong dollar that's already broken through its resistance area, And our next target is all the way up to 82.78, which pushes the euro US dollar, see how we're pulling all this together? Pushes the euro US dollar back down to 131. Inflation may be bad, money miser, but deflation's worse. That's where we really get some real problems. So we're watching for this, and then if we break through that 131, what do we have next? That's the annual low. So we come back here and we say, okay, 131 clears, and we have a really strong support area where we put this in at 2013 near 128. This one near 127 is okay, but really I think at that point we do fall back and test 120. I really thought we were going to do that back here. I thought we were going to roll over and break that near-term support back here, but this is building up pressure, and we know we have problems there. They're already accommodative and more accommodative while we're talking about raising rates. That dollar strengthens, we see this fall down, and that's where we see everything continue to domino. All right. Just reading your questions, comments. Why have they not labeled this a deflation trend? Because they don't want to. Because they say, look, our CPI numbers still show that we have some positive inflation, and we're getting close to that 2% level, and that's what they want to be able to say, because that justifies the strength of their trend. That justifies the things that they're watching. That justifies everything that they've done, that it worked. And that's in the air quotes. You can't see my air quotes, but listen to them. It worked. All right, so as we're looking at this, right now, Wolves Trader, they've got to stop buying first. So I think we're still looking out to October for that move, so watch for that. Watch for them to stop their buying program, and then look for the commentary. It really is that commentary or guidance the Fed will give after they say we are done with our purchasing program, we've tapered it out, we're done, there's $0 billion buying every month. It's at that point that they'll start talking about the idea that they've done enough and now we're justified in raising rates. So we have to stop buying before we do that. And Money Miser, I agree, we don't need hyperinflation of the 1970s. But we do need to be careful that we don't kick in deflation. The dollar index is about 55% euro US dollar, about 30%, well, 20-something percent pound, about 10% yen, about 5 to 8% of their commodity currencies, and whatever yen is in there. It's a mix, but still about 55% of it. It's basically the same amount, but they try to keep it as close to the same amount of actual global trading of each of those currencies. All right, let's go over and look at, we already looked at crude light, but let's look at housing really quickly. I'm going to use home builders. Oops, XHV. I'll type that wrong. There we go. So one of the things that I think is a concern for me is that in spite of the fact that they say we've recovered, this is our home builders. We've fallen back through a key support level. We've been bearish, creating lower highs and lower lows. Remember that the crisis started with home building. Go back to the weeklies. We're still up here at the tops, but we are putting in a long-term reversal. So we've ended the bullish trend. We've now broken through support. If this is a long-term head and shoulders type pattern, then the move from 34.05 down to 30.70 could duplicate, and then we'd be looking for a move closer to right down here to 27.36. And you could do the same thing with toll. It looks very similar, breaking through its support level through there. You could look for the DR Horton, and it's breaking through its support level through there. You could look at Pulte Homes, and I'm looking at the 3-year. So seeing that we've topped out, we've ended the long-term uptrend, and now we're possibly creating lower highs and lower lows, and we're looking at moves that could take us back to the annual lows, and this is part of the sector we need to be watching as well. So as we're looking at that, that's a concern. Let's go back to crude light and then the pound. We've got time now. Relax. We're making great time. We've already hit the euro. We've talked about the yen. We've hit the Canadian dollar. Talked about the major market moves. We're going to be able to get to all of them. No problem. So as we're looking at this, crude light, like I said, this is going to weigh down Canada because we buy more oil out of Canada than any other country. But it is also important to the pound. So the pound, BP still accounts for about 10% of the GDP. And so we would say, okay, the pound should be weakening, but we haven't seen that correlation with the pound and the US dollar, or pound US dollar and oil, I should say, that we have in the past. Now we have broken through support, and this is one of the ones I'm watching for a trade setup, because what we've done is we've seen a breakthrough support, a drop back down to these support levels, near these support levels. This is the annual. And so this is what I'm seeing. We were overbought, definitely overbought, created divergences or a bearish sentiment there, rolled over, green line left the reversal zone, broke through trend support, dropped back down to near-term support, created a Harami, and today is a bullish candle, confirming the Harami being a bullish day. We already had a bullish cluster. It says look for the reversal. The problem that I have with this is the confirming candle that I usually use. I'll walk backward on the blue line until I find the peak out of the lower reversal zone. Well, it's right there, which means I'm looking for a close above this level. I put an entry order as a buy stop above the high, but at this point we're going to watch this level right here, this close. So if we close above 168.84 and we're at 168.83, we are right there, potentially turning this thing around. So the pound, we're not getting the way, it's not weighing down the pound with oil prices dropping. The pound has been able to maintain. In fact, the last 2 days, the pound has been able to gain against the US dollar. As we're watching that move, we're watching that setup there. Their PMI came in really good, so hooray for them. They also, construction spending is stable, so they have a lot of other fundamental news holding them up. But this is a candlestick pattern right through here, bullish Harami or a consolidation pattern with a breakout today. We had a bullish cluster, and the confirmation I look for is the close of that candle, and that's right where we're at. We're within 1 pip of it, and I'm not specific. So as I'm watching this, it needs to close above 168.84 on today's candle in the next 13 minutes, or it's not a trade signal. And so this would be a potential bullish reversal. Now that bullish reversal, I'm only looking for it to get back up to these support and resistance areas right through here. This is where I'd be watching. Now it could retest previous trend resistance, but look for a body here and a shadow there, and then settling in at 169.90. So it's about a 100 pip move on that, but the risk for that move is fairly reasonable because it is overextended. We've had this bearish trend, and it appears that we've broken that bearish trend. If you drop it down into the hourlies, you can see that trend going through there. And you can see that we've come down to this level. We've tried to break there before, but this on the hourlies, look at all those close, close, close. We did have one up here. Shadow, close, close, and right through here, we closed above it, thought about it, closed above it, closed above it. So we have 3 hours closing above our long-term trend line on the intraday, and that's why I'm so close to giving me a bullish indication where I'd be looking for it to get back up to 169. Let's call it 170. Test of 170. Now if it can clear there, we could go up to 171. The dollar has been pretty strong, but I would be looking for that to move there. Let's talk about the Swiss. What drives the Swiss? Banks. Now this is one that kind of got me confused. I'm not necessarily confused as far as why the Swiss is weak, but why have we not seen banking do better? Because we have, historically speaking, and I'm talking about hundreds of years, Credit Suisse, UBS, all Swiss banks have been the primary source for the Eurozone and the Middle East. When things are uncertain, geopolitical problems arise, money rushes over to the banking sector, and generally they make money. So if you look at UBS, though, this is not good for UBS. UBS has lower highs, lower lows. We had it topped out here. We created lower highs and lower lows through here. Look at this. There's our lower high, lower low. Let's use our fib band, which I think we'll probably just do fib bands next week. Even off of this, we have that target line, resistance line, resistance line. So I still have a lower target near 1611. And we keep seeing UBS struggle, and banking falls, and we don't see anything moving, and we see everything struggling, even though theoretically money should be rushing in there. No pun intended. When we're looking at all the problems that are going geopolitically. So maybe it's just UBS. Maybe they're struggling. Yeah, no faith, no confidence in UBS. They tried to hide a little bit more money. Hey, you know what do you know? Credit Suisse, though, same problem. Lower highs, lower lows. Downside, we still have some downside, 25.82. And so when we're looking at this and saying, wait a minute, the banks are not doing well. If the banks are not doing well, there's probably not a lot of demand for the Swiss franc. If the banks aren't doing well and we know the Eurozone is still struggling, the Eurozone struggling means the Swiss economy is struggling. So as we see the banks struggle and the Swiss or the European economy struggling, then we'd expect to see the dollar Swiss showing us Swiss weakness, dollar strength, which is exactly what's going on here. Now, we are at a key level. Notice we've created this lovely double bottom here. We broke out to the top side, and we've tested, tested, and tested. I actually like the idea of shorting the dollar Swiss here because we have 1, 2, 3, 4, 5, 6, 7 different times we've failed at this resistance. What I'm going to do, probably as part of today's commentary, maybe, I'm going to probably look at comparing that to something like the New Zealand Swiss and looking for the break of this support level, which I still don't feel bad about exiting this because we took that trade and we went 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days just flat as can be. So if we break through this support area, I'd be willing to short it back down to 75.53. And I'd like to see that break support at the same time that the dollar Swiss rejects this level. Now, if I want to take the dollar Swiss, we do have higher lows that we're going on through here. We could anchor that and look for that trend through there. If we break through and closer to 38 one more time, I'd expect 90.48. But this resistance area is holding. And so I'm actually looking for a bigger move back, maybe 90.05. But I don't know if I want to short the dollar against the Swiss. And so if I'm going to look for Swiss strength, I'd be looking for it to break through here. There's a lot of weakness in there. I'm looking for one more push lower on Credit Suisse, one more push lower on UBS, and so that could mean one more push higher on the dollar Swiss. So we might get another test, another attempt here, and we've done this before. So let's watch for one more attempted push higher, but then if we fail, then I'm looking for it to roll over. I'm just reading. EWG says it all. Let's take a look. This is EWG, for those of you who don't know. This one is the ETF that is for the German ETF. So kind of the entire German economy. Let's get rid of that. Yeah, let's get back to some channels. Strong trend, break of the trend. Lower highs, lower lows. Now, we could also look at this. It's not just Germany. Getting back to the discussion, even though this is Deutsche Bank is the German bank, and you can see the same sentiment towards Deutsche Bank as we see towards UBS. So a lot of bearishness, another push down likely on UBS, Credit Suisse, and Deutsche Bank. And by the way, UBS and Credit Suisse account for 60% of their entire financials sector. So if you thought the AIG and it was too big to fail, try UBS. Quickly reading through. What's the opinion on the euro-US dollar? Well, we talked about it earlier that we're seeing the dollar strength and we expect the euro-US dollar to drop all the way down to 131. That this breakout through here, yes, we have a little support right in here, 133.70, and some resistance there. But if we can clear that, if we can clear today's low, really is what it is, then I would expect us to drop down to 131. And then we talked long term that we're looking at some breakouts and some fall, some drop. If it drops through 131, we're talking 128, 127, and then all the way down to 120. And so we're still looking at this. We're still seeing weakness in the euro. This weakness could continue. Now this pattern right through here, this descending wedge, let's measure this. I've got to use a Fibonacci extension to measure it. So off this high to this low, because we're trying to break out through here today, that puts us almost right in line with this low. Pretty close. So this wedge should have us retest these lows. This is a triple leverage ETF as far as the financials. So remember, it's 3 times leverage, and that is the U.S. financials. So if you really want to look at like I said, there's a real difference. You see, we're still in a trend, long-term bullish trend on the U.S. financial market, but this is U.S. It's Credit Suisse and UBS and Deutsche Bank, the European banks that are really struggling right now. So Credit Suisse, the U.S. has actually been able to hold up. Let's look at DBA, because one of the ones that DBA start out with, and then we'll look at wheat and we'll look at corn. We're just going to look at agriculture prices here for just a minute. Kind of our last intermarket analysis tool, and then we'll look at some mixing up the crosses and the pairs to get some other opportunity. Let's throw a fib off the trend up. Notice that we came down and tested that 61. We tested the 50. If we break through the 61%, agriculture prices are likely to fall back to 24.12, which is going to take us back down to these lows of the year. Now, those lows of the year, you'll notice that's actually not bad, considering we're looking at wheat, and wheat had already pushed back to these lows. So here we are. Oops. Support, resistance. We'd already broken through the annual lows, retested resistance, fallen back down, new annual lows, and pulled back this week, everyday bullish for agricultural prices, or for wheat, I should say, and we're stopped right here at the previous resistance. So we're right at resistance. A failure here could push down into the lower levels. Corn. The trend here was even more bearish, breaking out to new annual lows, installing at this 38 and testing the 50. We have to go all the way back 5 years. Actually, I think it's 6 years, so we'll go 10. Nope, it's 5 years. 2009 to be able to get another low, 325. After that, you notice if we clear that 100% level of the previous pull trend up, now we're looking at a move all the way back to 193. That takes us all the way back to 2006 levels. So as we're seeing corn struggle, we're seeing wheat struggle. Yes, wheat's at a resistance area. You see coffee is actually in a downtrend. So all that big move, that really big bullish move that everybody was talking about, was nothing compared to what we had in 2010, 2011. So we go back in here into the 1 year chart. That big bullish move on coffee, yeah, we're just in the middle of it. That's held agriculture prices up. ZW, ZC, or corn and wheat have been very, very bearish. And the DBA has been bearish as well. So when we're seeing agriculture prices struggle, it doesn't stop us at that level. It tells us that that is a problem, certainly. But our big loser for today, surprisingly, was the New Zealand US dollar. So agriculture prices have been struggling. We saw this roll over, close down. If you're a price pattern trader, a couple things you might notice is you could call this it's a very small flag. Generally, you need to see 4 to 5 days consolidation, but we have 3 days up through here. If you're calling that a flag, theoretically, we could move that distance again of the flagpole, which means I'd start at the 61% level and go to 83.50, if not down to 82.78. Looking back historically, 82.78 matches up to this support level back in February. So we're seeing a lot of bearishness, and the New Zealand dollar was really, really strong, but agriculture prices are still falling. And one of the things I've kept saying, that it seems like we're getting oversold on agriculture prices. We are dropping down to the low levels. And so these low levels, I would be looking for the reversal. Yeah, so Dow, and that's kind of the thing that we were talking about last week, wasn't it? What is, remind me, what's cattle? It's, what is cattle? LE, there we go. See, it's not LC. It's not like cattle. There we go. So beef still doing well. Higher highs, higher lows at previous resistance. But what we've seen is we've pushed lower, we've pushed and pushed and pushed and saw prices lower, agriculture prices. And as we're watching those agriculture prices drop lower and lower, then that's the concern that we would have, is that maybe we're extending up lower and we still have room to move. A little bit of room to move to the downside, but we already saw the bounce on wheat futures. New Zealand dollar sold off. We've broken out to the downside. Cattle at support. I would agree with that. Oh, let me do natty gas first. So natural gas, question is, are we at the bottom? Say you have a support and resistance level line there, so it could put a base in here. Let's zoom in on this a little tighter. This trend may be ending, this bearishness. Let's get even more precise. I have not looked at natural gas today. So a couple of things we would note. We were falling back to previous resistance. We created a bullish cluster here. Now this is one of the things we talked about last week, is in the weekend update, is that if it stays in a bearish cluster for 4 days, 1, where all 3 lines stay below 20, 2, 3, 4, 5, when that happens, generally I'm not looking at it as a big reversal. It will give us a pullback and likely extend down again. So at this point we got a little bit of pullback. I would expect a lower high, maybe a different trend. This is just me from the indicator. When I have that kind of a consolidation in the lower reversal zone, it tells me there's still momentum behind there. So what I'd look for is I'd look for natural gas to pull back, give me a lower high, maybe at or below 411. And then roll back over and then push to one more new low, and that's where I'd be looking to put in the base for natural gas, and that would probably be in this area near 347. And that give us 2 months, 3 months, and then we start seeing weather change and demand for natural gas going up, and away we go. Cotton picker, what are you talking about? Which symbol are you talking about? Are you talking about corn or wheat, or what are you referring to? Let me know. You want a fib extension on that? Sure, why not? I'd first start with that one and say there's a 61%, that means 349 would be the next one, and 349, look at that, magic. Now we put the natural gas chart up again. That's what we're on right now. I've got other stuff up here. This is the natural gas futures /NG. I don't have log scale on. Yours might have a log scale. I have mine as just standard. You mean with the link? Try that again. Close. There you go. There's your link. Let's look at HG as our last one for our intermarket analysis. You know, I'd be pushing out to September. Ole. Maybe I'll call you that from now. Ole. Yeah, and Phoenix, I agree. You do use natural gas in everything we touch. We do. I mean, we have a number of natural gas power plants out here, and we also have a lot of natural gas too. So we still only, even when we're getting more and more natural gas cars out here because we have lots of natural gas filling stations, and there's still like 96 cents, I think, or 90 cents a gallon or something like that for natural gas. I can't remember what it is because I don't have a natural gas car. But yeah, it isn't everything we touch, but we actually get when we do get it colder months, we have a bump up in demand. So what I see is kind of that core thing that you're talking about, everything that natural gas touches, all the manufacturing facilities and anything that we use to heat and power, all those things generally get touched by natural gas, but we'd still get that's kind of the static flat, and then we see an increase as you go into the winter months, just like heating oil. Yeah, oil touches everything we have, right? Everything from cars to transportation to plastics. But during the winter, heating oil goes up. Oil prices tend to go up. Same thing with natural gas. It touches everything, but we get a bump. So, all right. So looking at copper, this is one that I keep telling you, this is the one, what I like to look for and say, do we have real growth? And I know there are some that would disagree with this, but I still say this is my favorite growth indicator. That we're trying to put in a base all the way back to March, April, May, June this year. We're not getting a strong rally. If we look at copper prices going back, we're still at some significant lows. Demands are still way down on copper. And that is telling me that we're probably not in the point where we should be raising rates, because we could crush it. Somewhere in the middle, 9, 10, 11. That's when we had a lot of growth demand. 2008 certainly crashed. You can see a lot of the economic, really you can see a lot of the economic booms and busts. 2006, big move up. 2008, big crash. 09 to 2010, when we had all the money going to the markets. But you can see a lot of the booms and busts. And we're sitting here stuck in this little sideways range, going all the way back to 2011. It's not growth yet. I know we have a lot of reasons to look at it as growth, but we're not growth yet. Leopold, it's probably my voice. Just my voice is crappy. Alright. Everybody else let us know if the audio is bad. Okay, let me pause the audio for just a second, see if that helps. Is the audio better now? Does that help? Did pausing it help? Let me know. Okay. So let me just send this to you. Let's share the study. All I did with the market forecast is put in an 80 and a 20 line. That's all it is. Okay. So there you go. Still breaking up? Let me try one more time. How about now? Okay. Evidently we've only got 7 minutes to go, and we've got audio problems, but let's just keep on hammering it out. Yeah, all I did, Stevie, was added the 80-20 to the market forecast. That's all it is. It's just a plot. There's nothing special with it. And so I just put that link in there if you want it. Well, we're getting kind of a mixed signal there, because some of you are saying that the audio is good, some are saying it's not so good. We have, like I said, 6 minutes, so if I try to correct it at this point, it's probably going to struggle, or we'll probably burn up the last of our time. I can try this really quickly. See if that helps any. Alright, so as we're looking at this and we're looking at copper, it still looks fairly bearish. I'm looking for a pullback to 310. If you're a futures trader, that's actually a lot of money to be had in those ticks down to 310, but we're not worried too much about that. So go one more time back to the Euro-US dollar. We're looking at the Euro-US dollar. We see that there's a weakness here. If we expect the weakness to continue, I would also be willing to not only short the Euro-US dollar, but I'd also be willing to go short. I'd also be willing to go short the Euro-US dollar as well as the Euro-Yen. So as we're looking at the Euro-Yen, what this is going to do is give us a little bit more time. If we're going to see more uncertainty and more struggles here, I'd be willing to look at this back down to support, call it 135.14, go the Swiss yen. As we know, the banking sector, we're just starting to pull all these things together. The banking sectors and Credit Suisse and Deutsche Bank. Not only should we see it retest the support level near 112, but if we break through there, first target is this small channel. The small channel from 112.20 up to 113.20, that 100 pips should not only push us down to 111.20, but likely down to 110.64 over the near term. And let's go back to the dollar yen again. So the dollar yen, I'm expecting both strength for the dollar and the yen if we see more uncertainty continue. And so honestly, I think we trade back, we stay in this range. I think there's a high likelihood if we are going to break one side or the other, I'm favoring the dollar. And so we keep trading in this range sideways. If we do break higher, I'm going to favor, or better said, if we're going to break out, I'm going to favor the dollar on this, which means I'd expect the dollar yen to get up 105, but gives us some room to decide. This is a kind of a bull flag right now that we're seeing currently on the dollar yen. 1, 2, 3, 4. Today would be the 5th day of consolidation, so this would meet a standard flag scenario. And so I might just simply say get above this level or break out at 102, and then we should see that same move, 110 to 103. So therefore our target is right up here at 104.80 if it does break through this high. So we used to talk about the VIX cycle, and it still ties to what we're talking about here. Let me get rid of the average true range and say goodbye to our market forecast. And let's go back in and let's look at this cycle that we had before. We didn't get the same bounce that we had expected. We had these lovely cycle patterns that we're going through here. We saw the spike higher, when we rolled down. We should have had a spike higher. We didn't get it. We got delayed. So now here we are getting the spike higher. Could we? Possibly. Notice these spikes even back here, pretty close almost every single time at these key levels within a couple of days. But we had this situation where we spiked higher and then rolled up here. I think we could do the same thing that we did back here. Here, we're rolling up, and that means our spike could hit. If we're looking out, this went from February 3rd till May 27th, so it's got 3 months, 3 weeks. So we're talking about mid-September. I think we could have the same kind of a spike that we had back mid-November last year. So let's look for a move up to 21, if not 22, by mid-September. Yeah, U.S. Fed is bigger than the Bank of Japan, certainly, and the Bank of Japan really doesn't have anything else they can do. We've at least tapered off our buying program and are getting closer to the point where we might raise rates again, so that could give us more tools in our arsenal to be able to do things. But right now, I think this is what I would say, Dow. Watch the Bank of Japan. Watch the yen. Because what we're seeing here is we're seeing the experiment that the Fed is following. We're seeing the experiment of never-ending low interest rates and spending of capital to keep the bond prices high and the yields at zero. And depending on what happens with the Bank of Japan, if the yen is crushed completely, or if they see hyperdeflation, if we see the Asian contagion again, then in that situation, we could see some major, in a couple of years, we could see the same problem that the U.S. or the Bank of Japan has. We could see that same problem here in the U.S. And so there's a lot that's going on, and you should, and I think absolutely, you should watch the Bank of Japan. Yes, we're bigger than they are as far as that goes, but you should watch the Bank of Japan as an indicator as to what might happen with the U.S. economy and the U.S. banking system. Miracle, do I use fib retracements only for support, and do I use moving averages? Occasionally we'll use moving average. Well, Phoenix, here's the problem. I don't think we've got the Bank of Japan's fixed their problem. And because they haven't fixed their problem, would you be surprised to see another banking crisis? Out of Japan? And so that's what I'm watching. I just don't know if they can pull out of this. Right? And so if we see that same crisis, I don't even know if we can even get back there on the charts anymore. What about that? What if we saw this again? And if the US follows suit, I wouldn't look at it on this chart, but look at this. I wouldn't expect the dollar to lose ground at the end, but I mean, there could come a point where we could collapse. But we are bigger as far as our banking system goes. But this is not far-fetched. I don't believe this is far-fetched. I don't believe a dollar-yen pair up to 145, 147 is far-fetched. All right. You can call this your XA right here, Money Miser. Wave 5. Yeah, there's a lot of the ways you can look at this, but I'm watching it. I'm being careful with it, and this is something I'm paying attention to, and we're out of time. So hopefully the audio wasn't too bad in the last 5 minutes. Thank you for being here. Thank you, as always, for being here every week and your participation. I appreciate your time. I appreciate the fact that you have the interest in the Forex market as well as what we have to share with you here in Shadow Traders FX Hour. Let me know if you have any questions. FXtrader@shadowtrader.net, or you can always go to shadowtrader.net and find this under the archives under FX Hour. So this will be posted here a couple hours it takes to render and post it. But we'll look forward to talking to you again next week, same time, same place. Have a great and successful week, everybody. And from all of us at Shadow Trader, should we do the Canadian thing? Keep your stick on the ice. All right. Thanks, everybody. Take care.